So an asset price bubble is basically when a particular commodity or a particular product on the market is overpriced. The product has to be multiple times overpriced. It has to reach a level of being overpriced whereby it causes massive inflation, and the price has to be very multiple times higher than it's supposed to be for it to be classified as an asset bubble. An asset bubble, for it to be called an asset bubble, it has to reach a price, or the price has to be so irrational that, or so much higher than its intrinsic worth, that if it were to collapse back to its intrinsic worth, it will cause an economic, it will have a massive impact on the economy, loss of jobs, etc. That's what an asset price bubble is. A good way to understand it easier is to think about my previous video on the efficient market hypothesis. The efficient market hypothesis suggests that economic actors, which is basically people that buy stuff in the economy or people that engage in the marketplace, which is me, you, pretty much everybody. Economic actors, whenever we're making a purchase or whenever we're considering making a purchase, we are rational in that we have the relevant information necessary to make that purchase at a fair value, at the right price. So a fair value price is a price close to its intrinsic worth as possible. So I used an example in my previous video. 1 kg bag of carrots, if its intrinsic worth is £1, the closer we are to buying that 1 kg bag of carrots for £1, the more rational we are. Of course, I said in the previous video that this isn't the case. Most people overpay for most things, for a lot of things. So I discounted that in the other video, in my previous video. But that's a good way to understand the efficient market hypothesis. Is a good way to connect to to asset bubbles, and a good way to understand what asset bubbles are. So the main theme of asset bubbles, as well as the efficient market hypothesis, is rationality and irrationality. So I'll just explain what rationality is when it comes to making purchases, and I suggested that people don't always have the right relevant information necessary to buy something at the right price. Most of the time anyway. Sometimes we do, and there's different extents to which we understand the relevant information necessary to make the right purchases at the right price. So those two things linked together will help you to understand rationality, and it ties into behavioral economics as well, which is a recent branch of economics that has recently developed, which includes and speaks about efficient market hypothesis as well as asset bubbles. But yeah, it was just the main aim of this video was to help you to understand asset bubbles, and by linking it to the efficient market hypothesis. And I hope you guys have understood what asset bubbles are a bit more, and I hope it helps you to be a bit more rational when analyzing a purchase, and being able to understand to acquire the relevant information necessary to pay the right price and not to be overcharged.